All right, well, welcome. I'm Dean Jenkins from FollowMeTrades.com, and I was just listening to Price and David at the end talk about, man, I think Price said they've been doing it 26 years. David connected with him 21 years ago. Makes me feel like a newcomer because I launched my service, Follow Me Trades, 10 years ago. But, that's still a fair amount of time. And I've been here on many timing research events in the past and always enjoy it. Appreciate David and Enka inviting me back, and I appreciate the traders who are here. And this event is focused on the 30 presenters and the indicators that they use in trading. And I thought it would be kind of fun and hopefully useful for people watching um, to talk about no indicators, right? Reading price action with no indicators. And, I use indicators in my trading and in my chart analysis. But I think it's really important to be able to analyze, price action on a chart with no indicators. And then we can bring in, some indicators, hopefully in a pretty simple way that, kind of help us interpret or confirm what we're doing. But I'm a really strong advocate of, first and foremost, being able to read and interpret what is going on a chart simply from the price bars or the candlesticks. I prefer a candlestick type display. It's all the same data. All right. So that's what we're going to talk about today. And for people listening, I'm going to talk for just a few minutes, about what indicators are, what they do, and why I think it's important to be able to interpret price action first without indicators. And I'd be happy to do that live, right, as I talk about some of the chart analysis concepts to do it with symbols you're interested in. I've got a list of symbols here that demonstrate some concepts, but I would love to do it, on the fly with symbols you're interested in. So maybe be thinking about that, or you can even type them in now, and we'll apply these concepts to things you're interested in for sure. And this is ultimately for your benefit. So feel free to ask comments, ask questions, or make comments as we go. We'll have a dialogue, right? Just group of traders sharing ideas here. All right. So here's a fun slide, an image. I've actually started, uh, I do a weekly market newsletter now. I'm including a little fun cartoon using AI to generate it. So hopefully people are enjoying that. But one of the characters in this is Lucky the Leprechaun, and Lucky does all kinds of analytic techniques. You can see on his green board there, the all kinds of super complex, vortex and moon phase and candle formations and all that kind of stuff. So, question is, hey, are you feeling lucky? And we can all kind of get lost and go down into overly complex analysis, and that's why I like focusing first and foremost on chart patterns, candlestick, formations, right? And then here's a quick shot. I just took, I use Thinkorswim as my platform now, and I just went and threw as many indicators as I could on there real quick, and got the buy thing. And I've actually, I've done a fair amount of coaching and mentoring over the years, and when I do that with a student or a client, we share screens, and I've actually seen trader screens that look very, very similar to this. And you can see there's just, there's a ton of indicators, and ultimately, price action is obscured. And, it's kind of like, if you were to try and drive your car just by looking at GPS and not actually looking out the window at the road, right? So, it's just a little tongue in cheek, hey, does that look familiar to anyone here? Right. And maybe there's a better way. So I think it's important to first start, with just a quick discussion, what really moves the market? And I start with the idea that price and volume They're the only realities in the market, right? All technical tools, all indicators, boil down to two things, right? Price and volume. Everything else is, some formula, some algorithm, some reinterpretation of price volume, right? All indicators are derived from price and volume, right? Moving averages, MACD, RSI, everything. They're built from, four data points on a price bar, right? Open, high, low, close, and then there's volume also, right? And those price bars can be generated in your platform, right, at different time intervals, but every price bar, every candlestick is built from open, high, low, close, and then there's a real volume associated for the time frame for that candle bar, right? Then the other reality is that, this is from Benjamin Graham, who was, kind of the father of value investing. He was a big influence on Warren Buffett. He said, hey, the market in the short term is a voting machine that reflects emotion and popularity, right? News and, kind of the crowd response. And then in the long term, it's a weighing machine. It's a scale that weighs actual value, actual, market cap and earnings and all that stuff, right? But the shorter the time frame, the more unpredictable the market is because the shorter price movements are driven by noise and headlines and emotion, not necessarily changes in fundamentals, right? And it's all, ultimately there's the efficient market theory that says, the market is the market, the price of a security is the market, the overall market's response to all publicly known data, right? And as new data comes out, the public response can be, noisy and emotional, right? And then ultimately it will settle out into that longer term weighing machine. So I think that's important to remember and realize, right? Price volume are the only realities, right? So uh, some indicators or studies, or analytical techniques, you know, can create some forecast, but that's probability. That's not promise. And, I'm a fan of a simple application of Elliott Wave. I learned it from Bennett McDowell, trader's coach, 10 years ago. And I like it. And, for a simple approach to Elliott Wave, we use Fibonacci retracements and extensions, right? Some people use, legitimately, some traders use, or people are selling systems that use, uh, astrological, um, stuff, right? The sun, the moon, the tides, and how that affects the market. You can decide whether that has merit or not, right? But there's several indicators that do try to predict, right? I also use a simple version of Ichimoku Cloud, and it does predict some levels into the future, right? Sometimes they work, but that's probability, right? And they're still based on the past, past price, past behavior. And then in the market, there's clearly patterns that do repeat, and there's recognizable patterns, whether it's, Elliott wave or, a time and price repetition or a channel that has a defined high and low. And there's several other patterns, right? And so those patterns can repeat until they don't. Right? So markets tend to rhyme, not always repeat, and it's a probability, not a guarantee. So that's super important to remember, right? And then volume, again, kind of tongue in cheek, you know, people use terms about, conviction or weakness or stuff like that relative to volume, right? Again, thinking back to Benjamin Graham's statement, the market is a voting machine and then a weighing machine, right? So volume reveals what I call the size of the stampede or the retreat, right? Price shows what happened. Volume shows how much, how many people participated in what happened. Okay. So in and of itself, it is not predictive, it's descriptive of the past. All right. So price action, you know, the, each candlestick or price bar, open, high, low, close, and the volume, right? That's the original signal. It's reality. And since every indicator is built from price action, reading price action gets you much closer to the truth. And I think the progression of price bars or candlesticks on a chart, I like to say it tells a story, right? There's quite a bit you can learn or interpret just from looking, right, at a chart with no indicators. And it can hint, if it tells a story, it can hint at the next chapter, right? And give us an edge. And I like what Price said, hey, I just caught the last few minutes of his presentation and I got nothing but respect, right, for Price, man. He's been around a long time, knows what he's doing. Um, that uh, you know, when everybody wants to win as many trades as possible, but profitable trading comes from the size of the wins more than actually the number of wins. I'm in complete agreement, right? That and there's a mathematical basis to that, right? And turns out if you have a 2-to-1 payout ratio, meaning your average winner is twice the size of your average loser, you can lose even less than half, or you can win more than half or lose more than half of your trades. You can have like a 40% win ratio and you can be profitable with a 2-to-1 payout ratio. And the higher you can push your payout ratio, the better your profitability, right? It takes the pressure off. I don't have to win every trade. I just have to use good risk management and let the winners run, right? And so reading price action can, help you define your setups, and it can also help you stay in trades longer to get the bigger winners. So I think it's a super important skill. All right. Again, jump in with any questions, comments. Tell me if you agree, tell me if you disagree, or ask questions, right? All right, so let's get into it, right? That's the setup. Let's actually look at charts and use some tools and read some price here, right? So, two more slides because this one is important. I want to talk about a pattern that I use a lot and I look for on every chart. And so this is, this isn't all of Dow theory. This is a part of Dow theory. Charles Dow, back in the 1890s, founder of the Wall Street Journal, right, wrote uh, some significant literature on his observations of markets. And one of the things he talked about was trend analysis. And he said, hey, obviously the market sometimes goes up and sometimes goes down. What's the definition of a trend? And the definition is, an uptrend is a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Definition of a downtrend is lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Okay. Um, Pretty simple when you see it, but kind of in the moment of looking at a chart, and particularly if you're in a trade, um, it's good to have something simple to fall back on, a definition like this, right? And we'll demonstrate it on charts, right? So, when does an uptrend, a bullish trend begin? Well, it takes 3 data points. It takes a high, higher low, new high. As soon as this price exceeds this price, the trend has begun. When does it end? Well, when we stop putting in highs, right? So we got, higher highs, higher lows, and then we got a lower high and the prior low is taken out. Bull trend's over, right? And it turns out the beginning of a bear trend or a downtrend looks exactly like the end of an uptrend, right? You get low, lower high, new low, trend begins. And then the ending, it's not putting in any more lows, right? Higher low, new high. So that's just a working definition of uptrends and downtrends. And you can see them at any time scale, right? The market's fractal, whatever, you can look at a 1 minute chart, you can look at a monthly chart, right? These concepts apply, right, to whatever time frame you're studying, right? And and then that's where, Elliott wave comes in, where you can have big waves and there could be smaller waves within then corrections and stuff like that, right? Gentry's asking, can I recommend anyone the best book for Dow theory? Well, you can go read the original. It's available on Amazon, right? Uh, it's dense, right? And there's a lot to it. Um, if you want to learn how to apply it to trading this and the other stuff, well, I just happen to have some courses on my website, followmetrades.com. I have a Master Traders course that includes this and some other stuff. Um, and I also have a couple books on Amazon, right? Basics of Trading and the Seven Habits of Successful Traders. So I recommend those books. All right. That's the last slide. Thank goodness, right? Let's get out of PowerPoint. Here's a chart. Here is the S&P 500. Uh, and you can see I'm using Thinkorswim, absolutely no indicators. Okay. And I have nothing against indicators, and I do use them in my trading. In fact, I've got in Thinkorswim, uh, the indicators I use prepackaged, right? I'll just show you, maybe. Sets, FMT indicators, ads. Okay, here it goes. Plot. Okay. There's what my indicators look like. Pretty simple, pretty clean. And for me, the important thing, I've got a price oscillator, two moving averages, 250, and a simple version of the Ichimoku cloud. But the critical thing here is I can still see price bars and I can still see price action super clearly. So let's go ahead and take it away. Because again, and I encourage um, analyzing charts first and foremost before you look at the indicators. Okay, so here's the S&P 500. Okay, and we can analyze this using some powerful tools and the drawing tools that are built into your charting platform, into every charting platform that's worthwhile, um, can absolutely be used to help you in analyzing price action. Okay? So here's the S&P 500, the SPY, right? The ETF or the S&P 500. First, I like to, when I first bring a symbol up, let's just switch symbols for a minute with Apple. I always want to see the big picture. And like here in Thinkorswim, it comes up kind of unscaled. I use auto zoom, get rid of this because I've obviously analyzed it before, right? And this is a daily chart. And, I have Thinkorswim set to bring up 5 years worth of data as a starting point for a daily chart. And so I'm looking all the way back to, 21. So I want to see the big picture, right? What's going on over the last couple of years, right? And then I'll zoom in, right? I'll zoom in and start analyzing, current price action. But on the SPY, right? So we start here, big picture, right? And then just make some really, really simple observations, right? And you can go ask a fifth grader, right? Hey, pull this chart with them. What do you see? And I think, it would go, looks like it really went up and then it went down and now it's going up again. That's an important observation to make. All right. And then, like I said, I like a simple version of Elliott Wave. And since I've looked at like 10,000 charts trying to use Elliott Wave, it jumps out at me that something, important has happened here relative to Elliott Wave, right? And I can just draw it for you, right? There was a big move, right? This whole thing, was a really big uptrend. And then, like our fifth grader pointed out, then it went down and now it's going back up again. Um, and Bapham is asking, do I use Fibonacci? Yeah, I do. And you're going to see it in just a minute here. And then another person saying, why don't I have volume? Hopefully, It's on your end, not mine, or I've been talking for 20 minutes to myself. Um, I'll just keep going unless someone says I don't have volume. Uh, all right. So made some simple observation, and this is a long uptrend, right? That went down and then it started going back up again, right? Well, that is the Elliott wave shape, right? Wave three, wave four, wave five. So, oh, kind of see it here. All right. So, in looking at this, and Bapam, you're a good straight person because I'm going to do exactly that. He's asking, can I show how to use Fibonacci tools to predict where the SPY is going to go? Absolutely. So the first thing, because you can see in this uptrend, there were some pullbacks, right? But Elliott Wave has some definitions about, how big does a correction need to be a wave four? We use Fibonacci retracements for that. And so let's bring up the Fibonacci retracement tool. And so in Elliott land, right, we look for a wave one and two, which is the beginning, and then this is all three. And so we actually draw the retracement from wave two up to the top of three. Okay. And you can see I've got the Fibonacci retracement tool configured so that the key levels I'm concerned with, which are these green lines, right? And for some reason, oh, I can't see it because the drawing tool is in the way. There it is. Okay, 38.2 and 61.8. That is the expected retracement zone for an Elliott wave 4 retracement. And typically a wave 4 has an ABC component to it. And this one is kind of like perfect, right? And by that, I mean, what do we mean by ABC? Here's a move, A, and then there's a move in a different direction, B, and then here's C. And a perfect, wave 4 goes into this zone, and wave C is approximately 1.5 times the magnitude of A. So A, B, C, we expect C to be longer. Boy, this one was just like a textbook wave 4 on the S&P 500 on a daily chart. How cool is that? Huh? But then back to okay, so now, here we are today, right? This would have been good, right? And it was good. Back here, okay, we had a wave 4. How do we know when wave 4 is over and the next up move is beginning? Well, we go back to that Dow theory discussion. I'm expanding. We can see it more clearly here, right? We had a nice wave 4 correction, right? And how do we know when the next move, it's like, okay, the correction's over. It's heading back up into wave 5, right? Well, if you remember our discussion on um, uh, Dow theory, and why isn't the drawing tool working? Try it again. There we go. Okay, right? What are we looking for? A, a high, a higher low, and a new high. So Dow theory told us that this uptrend, this downtrend correction was over and this uptrend was beginning here. Now we can confirm that with some indicators. I use moving averages, Ichimoku cloud, price oscillator, right? But I can see it here without any indicators, right? Very clearly high, higher low, new high. Oh, look at that, uptrend. Okay. And then to the super important question, well, how high is it going to go? We can use Fibonacci extensions. And these are not an indicator. These are a tool, almost like a drawing tool, right? So The Fibonacci extensions need 3 data points. The retracement needed 2, needed the beginning and the end of the impulsive move. Right? The extension needs 3. Beginning of the trend here, the high here, and then the bottom of the correction, which is here. By the way, this works in reverse. You can do the same thing for a bearish trend. Okay. So the price target for a simple version of Elliott wave is a Fibonacci extension level from 61.8 to 100%. The green lines, I pre-formatted my Fibonacci extensions. And by the way, if you're using Thinkorswim, every platform that is worth using, you can do this, right? Your Fib extensions, right? You can edit it. You can go in and say which levels do I want, what color, which ones do I want to show, which ones are heavier or light. You can format it. And I've done that. So the target zone for wave 5 is 61.8 to 100, right? Or on the SPY, 632 to 726. So we're putting in record highs, right? Incremental record highs, 11 so far this year. But there's more room to go. Okay, well, that's helpful. That's a probability. That's not a certainty, right? Keep that in mind. But that's a nice probability to have on your side. Now, is it going to go straight up? Can you just go long and forget about it? Maybe, right? And again, it's probability, right? And it's not going to go straight up. It's going to move like price action moves, which would be probably in a series of higher highs, higher lows, something like this. Okay, not this. All right. And then while we're looking at this, just for fun, it's pretty much every chart we look at is just so rich in things you can do, right? With simple price analysis. I'm going to take the fib retracements and extensions off because again, there's super cool stuff you can do with just analyzing price action and using some drawing tools. So like the S&P 500 went up for a long time. It was an uptrend marked by a series of higher highs, higher lows, higher highs, higher lows, until it wasn't, right? This downtrend was over when it took out this low, right? Price went below this last low. We can use trend lines, which here on Thinkorswim, here it is. It's just a line, right? A line that you can draw. And for an uptrend, you draw a trend line on the lows, right? And here it's not perfect, right? So these are the major lows. So if you were looking at this right here, you would pick, kind of the extreme lows and you would draw a trend line from here and you would, intersect it with that low there, right? And that shows you, the kind of the bigger uptrend, right? With some minor pullbacks in it. But these are the major support levels, right? So when price breaks down through this line, well, that's a warning, right? It was following this line, and now it's gone down through it, right? And if we zoom in on price, was there a Dow signal of a lower high? Not super clearly, right? It kind of was a pretty big move, right? If you remember the tariff stuff was ramping up, right? And the big announcement was made here. Wow, whammo, right? So the observable low, lower high, new low was here. Low, lower high, new low. Still tradable, right? And then it got pretty volatile. But trend lines are super powerful, right? And we could do it also here. So for a downtrend, we go up from the highs, right? We kind of go try to find the highs like this. Okay, so when the downtrend crossed here, right, it was probably over and the uptrend is beginning. And look how that coincides with the high, higher low, new high. So two different approaches confirm that the downtrend was very likely to be over. All right, that's helpful, I think. And now we're in an uptrend. How would you know when the uptrend is over? So we go find the lows. We draw through the lows on an uptrend. It's kind of like that. So uh, it's getting very close, isn't it? So there could be, a momentary pullback, right? It's risen very dramatically recently. So there could be some pullbacks, right? And you can see certainly trends within trends. I showed, the big uptrend here, from the extreme lows, right? But you could also draw it from more minor ones like this, right? Trend inside a trend. So you can have a lot of fun and get some good insight on what's going on with price. Uh, Drawing a few lines. Okay. So there's some other things, you know, fun with crayons, right? There's some other things you can do with drawing tools and some important uh, conclusions that you can draw. Let's look at Tesla. This is a good example. Tesla reports today after the close, and we will see, right? But when I see this chart, I don't really see an Elliott wave, right? It had a big move up, but then it retraced nearly 100%. That's too much. And it's been a pretty messy uptrend. But having looked at 10,000 charts, there's something here that catches my eye. And that is what we call a wedge or a pennant or a flag, all the same thing. And we can use the trend lines to do that. And what we see here is, right, price action getting tighter and tighter, narrowing, right? Each of these swings is narrowing as indicated by this drawing that I've just made. And so the rule, I don't know if it's not a rule because it's not a certainty, right? But the thought behind a wedge or a flag or a pennant, right, looks kind of like the college pennants you'd see on a dorm room wall, right? Is um, price is compressing. It's tightening into smaller and smaller swings, and that is not indicating um, less pressure. It's indicating building pressure. It's like a spring coiling up. And when it breaks out of this, there's typically a follow through in that direction for a handful of price bars. And I'll bet you, I think there's a high probability that after the close, when Tesla announces their earnings today, it will break out. And at the open tomorrow, it will be outside one of these lines. And there could be some follow through momentum, uh, for the next 2, 3, 4, 5 price bars or days on a daily chart. That seems like it's helpful to know. Okay, so Tesla shows us pretty nice wedge. And you can see this on any time frame. This can be helpful if you like to day trade, right? If you're trading the E-mini or, gold or oil or whatever, right? You will see this on daily charts. In fact, let's just go look. I've got the SPY on a daily chart. And everything I just talked about can be used. Here's I'm using a range chart for the SPY, right? And yeah, I got a couple indicators on it. Say I use a few. I use a little different set for day trading. I just wanted to see if there was a wedge. Don't really see one. Um, okay. I don't want to get too sidetracked. Get rid of that. Say goodbye. Okay, let's look at Apple. Okay. So again, I always like bring up a new stock, get the big picture, right? And Apple's been, so we're looking, back into 21. So you've got about 4 years worth of data here, right? Obviously an overall uptrend, but been a little choppy, right? And kind of kind of down off its highs. Okay. And oh, look, what's this here? Let's drill in. Aha. This is called a gap, right? And it wasn't even, on Thinkorswim, these little icons down here are earnings, right? They tell you what the earnings was, conference call, and dividends or the green thingy, right? We got earnings coming up on the 31st, right? So we had this big gap and it wasn't earnings. It was kind of mid earnings cycle, right? So there was obviously some news, right? And oh, look, it was about first week of April. What would that news be, right? Tariffs. Okay. So Apple dropped with the rest of the market. So, a gap, what is it? Here's the price bar on the day before, and that was April 2nd, and the closing price on April 2nd. I don't know if you can see this line, if it's coming through on the share, right? This is the Thinkorswim. It's got all kinds of data when you mouse over, right? That's an April 2nd price bar. Closing price was 223.89. The next day, right, was the third. The opening price was 205. So there was a gap between closing price bar and the opening price bar. Means some kind of new information came in and the market reacted. Uh, the market reacted, right? Oops, do I have my right tool? So I pay attention to these gaps because they can matter. Now, how come that's not working? Oval. Well, so how about that? Trying to give a presentation, think something's not working right. It's okay. We have another tool. Use the zoom drawing tools. This is the gap for Apple. That means, using the uh, efficient market theory, that new information came in and the market repriced Apple and voted, right? In the short term, that we thought it was worth 233 a share. Now we think it's worth 205 a share because their fortunes may have changed, right? The amount they can earn based on what's going on is different now. So these gaps are important in that they can provide support or resistance. Support is a level that price comes down to and then reverses. Resistance is a level that price goes up to and then reverses. Can't seem to get through that level. Okay. If you look here at Apple, I think it's a true statement that price has come up to this gap and can't get through it. And whether or not there's a gap here, we can use just a straight horizontal line to observe a resistance area, right? Because we can just look at a chart and go, well, price came up to here and stop and reverse, came up to here and reverse, came up to here and reverse. Here it is again. It's a resistance level. Would you want to take a long trade right into a resistance level? I don't. Um, and the other thing that's cool about resistance levels is if and when price does break through, well, that's a big deal. Something has changed. The vote has changed. And that may be a place where I absolutely do want to take a long. If it breaks out of this, maybe I do want to take a long. What I like to see, let's go ahead and clear that. All right. All right. If it does break, I'm not going to take the first break. What I like to see is a break and then a pullback and then the next move. And what we can observe, and maybe you've heard this, other educators talking about it, is when they say resistance becomes support or support becomes resistance. So this is a resistance area, right? It's clear. Bam, bam, can't get through, right? And then if price does eventually break through, then that level can often now be support. A level price comes down to and reverses. It's just switched. So this is a pretty good entry for me. Right? I like this. It's like, okay, right? We're out of this, we're above this resistance area, right? And this could be the start of a new trend, start of something beautiful. All right. Um, and we can also observe on Apple support right here, right? And it's not perfect because we got this level here, we got this level here, we got this level here, we got these. They're a little bit different. But let's just take you know, a mean between them. And so it's a bit of a zone rather than an absolute level, right? But it's an important zone because price came down here, came down here, here, and here, found support, and then went up. And so when we have two horizontal lines, one, defining a support area and one defining a resistance area, we call this a channel. So for this period, starting in mid-April, Apple was in a channel. Okay. And so if price breaks out of this channel to the upside or to the downside, that's new. And that could be the beginning of a trend. So that's notable, worth knowing, worth paying attention to. Okay. So that's helpful. And we've done a lot here with absolutely no indicator. Right? We're just interpreting price action. So how good is that? Well, okay, let's move on to our next thing to analyze with no indicators. Intel. I like analyzing Intel. I worked for Intel for 14 years. And, you know, sorry to see their recent woes. Okay. Um, Luckily, I joined in 93 and got to ride the wave. Yeah, it was fun. All right. Anyway, what I like here about Intel currently, and hey, does anybody see a gap? Well, there's a couple gaps, right? But this is huge. This is a huge gap, and it happened on earnings last year. Huge gap, right? It was so huge that CEO ended up losing his job, which is too bad because Pat Gelsinger is a good man, and I think he might have been on the right track, but investors lost patience. So uh, there's a gap, and that gap is clearly a resistance area, is it not? Here's price, came up to the gap, failed, came up to the gap, failed, came up to the gap, failed. So that's worth noting. Uh, but this has been pretty chaotic. But what do we see, kind of on a small scale um, right now? But even though it's a fairly small scale, it is happening. So let's make note of this. We have high, higher, low, high, higher, low, high. Well, that looks like Dow theory. And we have a trend line forming, which is an uptrend. Okay. So that's interesting. Uh, and we can say, well, we do have this gap, right? So let's draw a line, you know, here's where it came to and failed, went a little above it, but this is a pretty good area. We go, that looks like a resistance area, right? Because prices come up to this and reversed. We got this uptrend. We got highs, higher lows, right? How much room do I have if I were to go long, but go, yeah, but recognize, well, it could hit this resistance level and stop, right? Well, current price is at 23.41. This is at 26.45. So that gives me, $3.50 of profit on a $23 stock. That's like what, 12 or 15%? I'm I'm sort of okay with that. And that leads us to another thing that we can do with drawing tools and price action analysis without an indicator. And that is we can use price action like I've done here. Oh no, don't blow up on me. Um, we can use price action. So I've established a level here. Like I said, I'm kind of interested in going long, but I think this is a level where price could stall. So we can call that a target, right? Now we'd be fine if it went above it if we were long. Let's say if it only went to this level, let's make that green because that would be profit, right? And then if I were to take this long, I'm going to blow it up a little bit here. Where would I put a stop, right? Where would it indicate that the trend has failed? Oh, well, we got some trend tools because if we go long and then the trend fails, we kind of want to get out, right? Well, here's a trend line, right? So if it falls below that, that could tell us that the trend is failing, right? And we've got Dow theory. We've got high, higher, low, high, higher, low, high, higher, low, looking for a new high. And that could actually be an entry level, right? We could say, hey, if it puts in a new high, I'm in. Okay. And I marked that as blue. That's just kind of my trigger level. Okay. So if it made a new high in this trend, I'm in. So I got an entry level and I got a target level. But what would convince me to get out? Well, we're looking for a high from here. And if we get it, this is going to be the latest low, right? Higher high, higher low, higher low, new high. So I think it would make sense to set this, at this moment in time, right? Based on what we see in front of us now, we would consider this our stop, right? And so we're going to make that red because that is bad. Okay. So if it goes up here and triggers, then this setup, okay, this would be a long. This would be my stop, right? If I get in and it goes down and goes below this low, I'm out. And this green would be my target. So simply analyzing price action and using some drawing tools, right? I've created a trade setup. And what's notable about these lines is we can visually determine the risk to reward for this trade. And, I said I agree with Price that, it's the big winners that carry the day, right? And I mentioned, if you got a payout ratio of 2 to 1 or greater, right? You only have to win half your trades to be a profitable trader. Um, but in order to do that, you have to take trades that have a good profit potential, that have a good reward to risk ratio. And we can see the reward to risk ratio here very clearly because our um, reward is the distance between our entry and our target, right? This is the profit. If this thesis, now if it went on more, that's just fantastic, right? But that profit, 214 entry to 26.75, right? That's a $2.60 profit. That's our reward. Our risk is the level between our entry and our stop. So here, 22.89, 24.15, call that 23. We're going to lose a buck and some change. So over here, we're making $2.60. Here, we're making, just over a dollar, right? So that is like a 2.5 approaching 3-to-1 reward to risk ratio, right? This is more than 2x this. That's good. Okay. If, if I get in and get stopped out, darn it, right? If I get in and it hits the target, that's going to be a decent win. I trade something like this with options, right? So, if we make a 15% move on the underlying stock here, right? And if we've taken you know, uh, a tick or two, right? A strike or two in the money, call option on this, we're going to make, um, 50 to 100% profit, probably, right? For sure, right? If it goes to the target. So, pretty cool, right? And again, this was all done uh, just using price action and some drawing tools to help interpret it. So, about that, a couple more, and we are running short on time. See if there was any super interesting ones. They're all interesting, right? Uh, AEVA. And if you'd like me to have a quick look at any, I see someone typed in Google, any others, go ahead and type them in. I'm happy to do it. AEVA, um, they are a bit of a meme stock, right? Uh, there was lots of buzz in Reddit, Wall Street Bets. They actually have an intriguing, emerging technology thing, right? They make uh, components for autonomous driving. They focus on LiDAR, which is radar that uses light waves, versus Tesla's focus on cameras. So obviously the thing was cooking along last year and earlier this year at the like a $3 range and peaked up here at 40, right? Wow. But now, is it over? Well, what we got here is a very clear Elliott wave three, big impulsive move and a correction. This correction, it's got an A, it's got a B, C, D, E. That's what's called a complex correction, and it's currently heading down. So you certainly don't want to jump in now because now you're just guessing. But if it were to then turn and give you a high, higher, low, new high, well, that could be good. And we could use again our Fibonacci tools and say, well, where, how did that correction look? Oh, wow, right in the middle of our expected zone. And now then, what does our retracement look like? Looks like something like this. So, according to Elliott Wave, this has real room to go, but it has to prove it, right? You have to get a trend change, right? Currently, it's in a correction, a downtrend. Now we need a high, higher, low, new high. But you don't have to catch the exact reversal, which is gambling, right? You can let it prove that it's in an uptrend, and then there's plenty of uh, room to run. And Bapin said, would my stop be on the option itself? And that's referring back to the Intel trade. And the answer is no. I take all my cues from the underlying, right? Um, so, like I said, if I were to go into this long, I'd go look right for call option 30 to 45 days out is kind of my sweet spot. One or two strikes in the money. If you if you execute a stop based on the option price, right? There's a bit of disconnection, right, between, because implied volatility and time and all these things can skew the option price. So I'm going to set my stop based on the underlying. And so if price hits the underlying stop, I will go close the option. I'm simply trading the option because I'm in the money, right? What I'm doing is just using it as a proxy, a leveraged proxy for owning the shares. That's all I'm doing, right? And because I'm in the money, I'm paying less for time, less for implied volatility. I'm paying mostly in intrinsic value of the contract. Okay. But there will be some impact, right? Some volatility of it. And then I control my risk by how much capital I put the the option contracts. Simple version is just say, if my risk management rule says, hey, based on a percentage of my portfolio, can't lose more than, $500 a trade. Well, you can then go, okay, I'm only going to spend $500 on option contract premium. That way, no matter what happens, I'll never exceed my max loss threshold, right? Or you can use an option calculator and get a reasonable prediction of what the option contract price would be at the stop on the underlying and use that to help determine your position size. But the cues are taken off of the actual underlying chart. It's a good discussion. It's a good topic. All right, UPS for Gentry. And then it looks like I was worried I wouldn't go at full hour. And then here we are up against the deadline. All right, UPS, you can see I've analyzed it before, and it actually, here we are, um, triggering, right? So here we are, UPS hit a bottom and it's starting to creep up, right? And I had seen this kind of channel and then a breakout and a pullback. And I like that pullback, and that's a support level, right? It hit it twice. Now it's heading up, right? So and I'm going to set a pretty conservative target right at this prior high here. But the reward to risk is still 2 to 1. So I kind of like it. I kind of like it now. The only problem is earnings are in a couple days. And I don't take a swing trade into earnings. So we're going to have to wait. But I like it. And so we'll have to see then what happens. And earlier there was one other GOOG. All right, Alphabet. Right? Earnings are tonight after the close. It's in a pretty nice uptrend. Again, we can use these tools and just very quickly from the, oops, wrong tool. Trend line from the major lows, right? We can see here's the trend line, and we can also see there's another shorter, sharper trend here, right? Let's see if it breaks that trend after earnings. So, you know, that's kind of where we're at. I am out of time. So thank you for your time and attention. Thank you to the hosts again, David and Anka for inviting me. And that is a wrap. Oh, and yeah, you can check out my website, followmetrades.com. And a really easy way is to come join my Substack, and I'll give you a quick link to that. And then and I will yield the floor to the next speaker. There's my Substack. Go check out the newsletter. Join for free, and would love to have you join us over